A diversified short variance portfolio in crude oil historically generated an annualized Sharpe ratio near 40%. Today, whether that massive edge still exists in modern financial markets is completely untested. Every foundational academic paper documenting this anomaly relies exclusively on market data from 1989 to 2011. This failure to arbitrage the premium is not due to a lack of institutional capital. It survives behind a severe structural data barrier that keeps the edge hidden from most funds. This equation shows the critical difference between the OVX volatility index and true variance. A variance swap pays on volatility squared. During the 2026 Hormuz episode, the OVX dropped 59%, falling from 126 to 52. Because of the math, that volatility drop triggered a devastating 83% collapse in the variance premium. Trading this successfully requires a full strike and maturity option service. The OVX collapses all of that surface data into a single, blunt 30-day proxy. To calculate true skew and convexity, traders must access the CME's CVol metrics, which are strictly gated behind expensive paid API channels like Datamine and Premium Channel 261. Paid data acquisition, not risk limits, is the primary structural barrier keeping this anomaly alive and preventing the wider market from arbitraging it to zero. This map shows the Strait of Hormuz bottleneck, the origin of a 2026 supply shock that drove Brent crude from $60.75 to over $116, before crashing back to $80 within 24 hours. On June 17th, the Versailles Memorandum of Understanding temporarily erased the market's geopolitical premium, triggering a massive 25% crude sell-off. Just 2 days later, the Bergenstock technical talks were indefinitely postponed, leaving the underlying military conflict entirely unresolved. Relying on a single 30-day implied volatility number is inherently flawed because the metric cannot distinguish between the pricing of a durable peace and a fragile, stalled truce. This chart plots the cumulative log alphas for traded options. Over the last 15 years, the once lucrative equity index option alpha converged to zero as market frictions eroded. The Becker and Giglio paper isolates this structural break to 2012, the precise moment net dealer gamma exposure flipped to positive. No equivalent decay study has ever been published for the crude oil variance risk premium. The industry is flying blind. Without a modern decay study, no one knows if crude oil's 40% Sharpe ratio has eroded like equities, or if the severe data barrier has protected it. Because there is no modern public replication study, it is impossible to confirm the actual capacity limit of a short oil variance book. This diagram illustrates the critical unresolved risk, a feedback loop where rising volatility triggers higher value at risk, sparking margin calls that force pro-cyclical selling in deep out-of-the-money wing strikes. Capturing the crude oil variance risk premium today requires navigating severe structural data barriers and blind margin constraints entirely in the dark.